Welcome, everyone, to another episode of Smokin' Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the opportunity to speak to Centurion Asset Management. Centurion is recognized as a leader in the investment and property management industry, providing quality investments and quality housing for all of its clients. We're joined by Greg Romundt today from Centurion to talk to us more about the products they offer and some of the advantages that they have. So Greg, thank you very much for joining us on Smokin' Bulls.
My pleasure to be here.
Right on. Maybe to get the day started, we always do this with our guests, is we give you an opportunity to share a little bit about yourself, your background, and a bit about the company that you're representing here. If I could, over to you.
So I founded Centurion 20 years ago now, a little bit over 20 years ago. And prior to that, I spent my career traveling the world running derivatives teams and trading desks for, Citibank and AIG, Toronto, New York, Tokyo, London, Hong Kong, Singapore. And eventually because I could trade anything with those institutions. That meant I could do nothing for my own personal investments. So I was in real estate. And eventually I got to a point where I was enjoying more what I did on my weekends than what I was doing for a day job, so to speak. And so I left and moved my family back. I was a young family at the time, 20 years ago, back to Canada from Singapore at the time, and started Centurion. I've been just growing it ever since. And today we're about 6.8 billion in AUM, primarily in apartments, student housing. We also provide financing on development of those assets. We'd be the second largest REIT of whether public or private in Canada, and the largest private real estate investment trust in Canada.
Excellent. Well, you've got some history behind you. That's good. Thanks for sharing that.
Yeah. So I guess maybe just fire away some questions for you if you want there. So for Centurion, then it's just one REIT, one piece that's your focus. You don't have any other holdings or funds that you offer to retail investors.
We do have our financial trust, which is a corporate and real estate lending fund.
Oh, interesting. Okay. Wasn't aware of that. We'll talk about that. Well, great. Okay. So, from a geographical, you're obviously North American. What would be the split between Canada, US be?
It's about 98% Canada and 2% the US.
Okay.
Canada's the home market, and we've been opportunistic. We're generally opportunistic investors. The U.S. is certainly more of a trading environment, even though we're not really trying to trade. We built quite a bit in the United States, but we saw some spectacular exits, so it wasn't our plan to sell, but we did sell. So that's why we're down to about 2% U.S. today.
Okay, good.
We got a few questions that we jotted down prior to our conversation, Greg. So one of the ones was in regards to real estate investment, and it's been a defensive industry in the past, but in current market conditions, why does it continue to be a good investing opportunity? Why does it make sense now?
So there's a couple of themes that have consistently been the case for years. In Canada, consistently underbuilds housing. That's almost always been the case. But there's a couple of other things, right? And I've talked about this in some of my white papers. We're currently going to be in an inflationary decade, right? And that's my core thesis. For a whole bunch of reasons, which is probably a whole other podcast. But suffice it to say, I think it's going to be an inflationary decade. And our industry in particular has a lot of tailwinds behind that. So one would be, last year into the country, we had the highest immigration in the G20, right? So we brought in 1,050,000 or so immigrants, including students. And we have the same expectation this year. We're not building enough housing for the people that are here, let alone the ones that are coming. And there's a whole bunch of reasons why I don't see any circumstance under which we can satisfy the demand or the shortage of supply. Next, if you think about the inflationary environment, one of the advantages of this asset class, other than the fact that it's a needs-based one, like everyone knows today, and although I said it before, no one needs an office, right? Because people can choose to start businesses and go anywhere or not, or go nowhere. But everyone has to live somewhere. So aside from that fact, now you've got this chronic shortage, a tremendous amount of demand coming in from people who are being squeezed out of housing because mortgage rates are high. Affordability is a real problem. So, and our lease rates reset annually. So that gives us, a tie to inflation in the rental income that we're able to generate. So, I mean, it's all really good tailwinds for us.
That's true. There's a lot in the news of underdevelopment in the housing market, massive immigration. That's, I don't think news to anybody, but a great opportunity from an investment perspective. Supply and demand requirements, right? You've got no supply and demand. So what does that do? I mean, you're going to raise prices there. So that's good.
Does Canada even have the capacity to catch up? I mean,
no.
Is there enough builders to make this happen?
So, this is the thing. So I'm going to take you through, and there's a whole bunch of reasons. I've been a cynic, or someone call it cynic. I call myself a realist, that we do not have the ability to meet the demand, even if we wanted to. There's a whole bunch of reasons. One of them that you mentioned is there's not enough supply of labor, of people who are skilled to do this kind of work. But let's say that we fix that. We won't. We have too many people coming in. So we can't scale these things anyway, but let's pretend that they were going to reduce the amount of excess demand. It's already been estimated we need 3.5 million more homes in the next decade alone than we're already on schedule to build. So we're on schedule to build about 2.5 million nationwide in the next decade, and we need 6 to have an affordable market. That's out of the CMHC. Wow. The next thing is a lot of transactions don't pencil. They don't pencil for a bunch of reasons. In the first place, it takes an extraordinarily long time to build in Canada because we have this excessive regulation and type environment. So in Canada, it takes an average of 100 months to build a new apartment building. In the US, it's about 24. So they can respond much more quickly than we can. And that's because we've got all these layers of regulation and community involvement, i.e. NIMBYism, that wants to keep development happening in someone else's neighborhood. And then about a third of building costs are actually government fees, charges, and levies, which mean things can't pencil, right? So it makes it very, very difficult. Even if we had the labor, the things won't pencil because of the costs involved from fees and levies, the time it takes. And, people say, well, okay, so it takes a long time. Well, time is risk, right? So as a developer, if you can build something in 2 years, or you have to wait 8 years, well, not only is there time value of money, but a lot more can happen in 8 years than can happen in 2, right? So you have to charge more and take that risk on. Approvals, all those things take time and money as well. And now the latest thing for the municipalities is inclusive zoning, which it's their desire to create affordable housing. The problem is that all that does is shift the burden of cost onto the developer who just says, I can't build this. And so they don't. I just don't see anywhere where they're making progress. I mean, even the feds have put aside, I think there was in the last month or so, a new initiative, which was, I think, tagged to be $2 billion. It seems like a lot of money. But on back of the envelope calculations, we need about $2.5 trillion of capital nationwide to build the housing that's required over the next decade. So I just don't see any scenario in which the government's coming up with $2.5 trillion to do that.
Yeah, it sounds a little oblique. I mean, even with all these empty office buildings, I mean, if people think, slap a number on the door and it's a residence. I mean, the conversion alone is just it's like building a whole new building on the inside.
Yeah, I mean, you see a lot of these articles, and it really doesn't work that well. There's very limited circumstances where this can work, right? When you think about floor plates of most of these buildings, right? You're not going to take Scotia Tower, which, whatever, let's say it costs $1,000 a foot, and downtown location, and convert that into apartments. It's just never going to happen. So you have to take the B and C quality buildings. Not all of them really have floor plates that are suitable for it. They're not going to have windows, right? Even the old office buildings didn't have windows. They might have a ladies' and a gentleman's washroom on the floor, but now you're going to need 2 bathrooms per unit, or a bathroom per unit. Where do you think that? Like, all that has to be plumbed. You think about an office building, and they've all got common air, right? So they're centrally controlled. But if you're going to be in a residence, you're going to want to have control over your my body temperature is not the same as anyone else's body temperature. So what I find to be comfortable is not going to be what the next person could find. So that's a whole new rewiring. And then the floor plate might not make sense either. Because if you have a very large floor plate, so how do you make a residential unit that's affordable? They have to be long and skinny, and that's actually not attractive either. So I just don't believe that, except in exceptional circumstances, where a building is economically non-viable as an office at any price, and then meets a whole bunch of other criteria, actually potentially could even be converted into residential. So it's just a non-solution.
Yeah. Maybe take us through a bit of your process. I mean, on the surface, you'd say, okay, we own, residential apartments and we rent them when we make money. How many do you build for yourself? How many do you buy that are in existence to put into the portfolio? Just maybe give an idea from a portfolio for someone who would be a client as to what they're buying inside of your fund.
So today we're about 21,000 rental units, over 160 give or take properties. We generally don't build our own, and there's a reason for that. As I mentioned before, there are all these kind of development restrictions, and this is not just a nationwide set of rules, right? You've got national building codes, but then you also have the provincial and you have local, and you can't be a local everywhere. And very often the best sites are 2 guys in a pub settling, right? So our model for finding new sites is really trying to partner with developers and provide them expertise on what to build, where to build if their site is good. We might provide them debt and equity capital. We might lease up, we might manage it, and ultimately, if they do a good job, we're very likely the end buyer. So that's our development strategy. We think it's far more scalable, and we'll do a better job of getting the sites that we want at reasonable prices by having local access and local partners who know the people on town councils and get them done, as opposed to trying to be a Toronto-centric firm pushing to across the country. That's been what's been effective for us. That's not to say that we don't buy things along the way. Today, we're predominantly buying new products. That's where we think the best returns are. But we do buy value add product as well when we see the opportunities and the numbers make sense.
Great.
Greg, maybe you can speak to a bit about how your fund minimizes volatility, but also how it's different from a publicly traded real estate investment trust or a REIT.
Yep. Okay, so that's really two questions, but I'll address it same way. So if you think about public versus private, we're very similar, in terms of governance, in terms of what we do in our business, and they think we're very similar. The difference is that investors come in and out at net asset value, as opposed to whatever the stock market's value is this second, right? Which could, as we know, those stock prices can be highly, highly volatile. So, we've got a long-term track record of doing it exactly this way. If you actually look at the underlying business, so you can think about a REIT that's public, what they've got is a business structure that's very similar to ours, and every organization is slightly different, but it's actually the same. But what they've got on is they've got a stock market wrapper, right? Which just adds an extra layer of volatility, which is not correlated necessarily at all to what's going on in the underlying business. And if you look at apartments, I think there's an index of the apartment sector, and I don't think there's been a negative year on an unlevered basis for the industry in almost 40 years. So I think what we're trying to provide is people access to that type of level of, those type of returns with a little bit of leverage added on. Obviously, real estate is a leverage strategy without the stock market volatility. So that's what we're trying to do.
Got it. So, if you're not in a publicly traded market, then that obviously leads to our next question, which would be around liquidity constraints. Can you speak to what that's like in your fund and, ability for clients to access or if, there's been stories of gating, of course, that happens frequently and funds, lockup periods exist. So maybe touch on a bit about that in your fund.
Sure. So subscriptions or redemptions are on a monthly cycle. We've never had to gate, but that's not to say that we never would. I think the reality is when you look at this type of industry, you have to say, what the kind of investors that we want to attract is people who are saying, I'm buying into an apartment building, and no one would think that they're going to buy an apartment building and flip it out the next month. And we're not, a money market fund replacement. We're meant to be a long-term investment. When we think about investors putting us into the section of their portfolio, we think we're in that lower to middle risk area, but we're also in that, when you think about tiering a portfolio in terms of liquidity ladders, we're also in that tier where you say, this is my long-term bucket. But people can move out if people inevitably do. We have a very low unit turnover corresponding to about 2 to 3% per year. So, but they can move if they want.
Good.
When it comes to obviously the difference between a stock and something that's illiquid like yours, what would you say is other than liquidity, any other risks that you would associate with your pool?
Well, no particularly extra special risks. We still have audits like, any publicly traded firm would have. We have a board of trustees, like majority independent, just like any public firm would have. I don't think there's extra special risks. There's a standard disclaimer that prospectus is regulatory approved, whereas an LWAM is not. I think that's a difference without a distinction. But, I don't think there's anything particularly extra that applies other than liquidity constraints. And I think you can solve for that by staying focused on the long term and, having it appropriately balanced in your portfolio, right?
Yeah, for sure. I mean, obviously the regular headwinds apply to both sides of the real estate. I mean, maybe we should talk a little bit about that, kind of the interest rate environment and how that impacts the business and how it can impact, obviously, the operating costs and the leverage of the fund. Maybe talk a little bit about those scenarios.
Sure. So leverage of the fund today is, call it around 46%, right around that range. We've, for the last number of years, been between, call it 38, 46, 38, 47. That's kind of been the operating range for us. Interest rates generally, not always, but generally speaking, when we're buying, we put on 10-year insured financing or government insured financing. So, we borrow historically, call it Government of Canada, 10 years plus 80 to 90 basis points. So that's still pretty inexpensive. Weighted average cost of our capital is, call it, around 3. It's pretty attractive. Today it's a little bit higher than that, but interest rate risk is interesting. It's an interesting one because the curve is inverted. If you're accessing those long-term rates, they haven't moved nearly as much. And more importantly than that, you've got these inflationary pressures bringing up interest rates, which had a reaction which I think most people wouldn't have anticipated, but I've said would happen all along, which is it's actually squeezing more people out of the housing market or the potential housing market towards rental. So, yes, your cost of financing goes up, but the potential for rent growth is, I think, higher than the risk for of higher interest rates. But when I would describe these things to cheap folks over the years, most people never believed me until it actually happened. But anyway, here we are.
Yeah, I think part of the rising interest rates was it would cause a bit of a contraction in the home prices, allowing other people to enter. And I kind of always shook my head at that. I'm thinking you might get a decrease in the price of a property, but all those people waiting on the sidelines to buy in now have a new mortgage at 7% instead of 4%.
That's right.
Your pure cost of buying that property nets out at the same per month for
much higher,
or much higher. Yeah. So I just don't see how squeezing somebody who's in one out lets somebody new come in. It's an interesting.
It just doesn't, right? Yeah. It just doesn't. Anyone who's not in the market is squeezed out because they can't get in even at the reduced price. And someone who's in, who might actually, let's say you live in Ottawa and you want to, sell because you've got a new job in Toronto, just for example. And let's pretend that the prices of the homes were exactly the same, which they're not, but let's pretend it. You probably cannot sell your place and buy the same priced home in Toronto because now you won't qualify. So a large number of borrowers are in negative or infinite amortization, right? Or, negative debt service. So in my world, we call that default. But somehow or another, the regulators have made themselves comfortable that infinite amortizations or negative amortization means your principal goes up every year instead of down is somehow a performing mortgage. But okay.
Yeah. Yeah. Well, they wanted to get rid of the 30-year mortgages, but then, you just bend the rule a little bit. You don't need to have 30 years because effectively you've gone there already and further.
That's right.
Yeah, it's definitely interesting there. So,
will that also increase rental costs? I mean, you've got owners renting their space out that are now perhaps under a higher debt load. That would potentially hurt a rental market too, I guess, because you're increasing your rental cost. Passed on to their renters.
I think that this is true. If you have higher interest rates and you've got somebody who, let's say, rents a basement apartment and they're using that to maybe fund part of their rental cost, I mean, you already have the pressure because there's not enough houses, right? Which is causing some rent inflation. But then you've got, oh, geez, if they were floating and they went from 2 to now 6, and so their mortgage payment has tripled, their income is almost certainly not tripled. And, we didn't get a break on property taxes, lo and behold, or income taxes or anything else. So I would anticipate that these will flow through as costs to renters.
Yeah, and I assume most people, when they're purchasing a property, probably in the last 5 years, you purchased up to the max of what your loan to value ratio was, your debt ratios were, and this just blows it out of the water. I mean, people obviously, they can scramble for a while and make it work, but they're just not. They're not doing half the other stuff that keeps an economy going. They're not spending money, they're not going out as much. They're, every dollar in is to stay afloat.
That's very true, and one of the things I've been very critical of government policy, and particularly the Bank of Canada policy. You don't jam rates up when you have a supply-driven crisis. You need production, which means you need capital to build factories. And, one of the prime drivers today of inflation, not only in Canada, but in the US, is actually cost of shelter. So if you increase the cost to build housing, not only because of the inflation of the product, and you don't cut fees and other costs or other things, and you bury people in red tape. Now, let's say instead of, one of the larger costs of construction, particularly when you use capital for, if it takes you 100 months, you have to carry that cost for that long. And if you double the cost of interest rates, that means either deals don't pencil or you need to charge a hell of a lot more money. So it's what has happened is the amount of construction is declining exactly at the same time that we need record amounts of housing. And it's the very policy of driving up interest rates, which is actually causing a reduction in the housing that everyone agrees that we need more of. So that just will continue to drive the shortage and rental demand.
Yeah, I think it's going to be hard to get it right. I mean, we've got housing increases, so across the board they see it as inflation. We should increase interest rates, which puts a pressure on the housing costs. Like it's just, it's the wheel that's turning the wrong way as far as I'm concerned. But yeah.
That'll be interesting. I mean, going through COVID, the supply issues that you touched on, now the increase of interest rates to curb inflation, that was probably driven by supply. This is going to be studied in economics classes in high schools and university for years to come. And was it the right thing to do or the wrong thing to do? It's just going to be interesting to see what the lesson is when we get through this. So what do you see as current opportunities and prospects for 2023? What are you looking forward to? I mean, we touched on a bunch of stuff that are headwinds, but what is also something that you feel is an opportunity?
Well,
the undersupply.
Yeah, I mean, I don't see that this inflationary problem is going to fix itself out, right? I don't think we fix the supply issue. I do not think that we fix so if you can't fix the supply, can you fix the demand? I don't think so. I don't think they're going to ever restrict immigration. I mean, I'm pro-immigration, but I think immigration goals should be balanced against our ability to A, house people, B, give them reasonable access to healthcare, and we're failing on both fronts. So let's say that they don't do anything, and I don't think that they will. What is the opportunity? Yeah, this plus my core thesis of the next decade of inflation means I think that they are not going to manage to fix inflation. we're too far into an inflationary cycle where debt loads are too high, particularly government, consumer, corporate, financial system, that if they keep rates at these levels, they will blow up the system, right? So I think we've got a decade ahead at least of negative real interest rates, which means if you can borrow inexpensively, below the cost of inflation, that's free money, right, for investors. The second side of that is if you can be behind the tailwind of inflation, that's good as well. So now that's the long-term strategic view. So yes, we want to continue to buy when we get opportunities. The tactical answer to that question is that I do believe that, Canada has been building, it's still not building enough or anywhere near what we need, but is building more than we have. And almost every developer I've ever met in my career tends to be over leveraged. And I do believe that a number of them, what we'll see happen is that because their cost of debt's gone from, call it 3.5 to 7 or 8, now means that, they may not have the balance sheet to do a takeout financing, which means they're either going to need equity and have to sell the project, or they're going to need mezzanine. I think ultimately we're going to see a large pipeline of excessively levered development players who are going to come to market with product that exactly meets what we want to own long term. And that'll be the opportunity for us to get a good supply of it at a reasonable price. So that's both the tactical and the long-term strategic vision of where our opportunity set lies.
Well, it's a rosy outlook for your side of the business, and that's good. And we get to take advantage of it by placing it in client portfolios. So that's good. I mean, selfishly speaking, from that perspective, the great story for Canada, but
not a great story for Canada. I mean, honestly, I would love to say that, we could find a way to fix this. For the country, and I just don't see a way that's ever going to get done.
Yeah, that's unfortunate. With kind of the highlights of what you've mentioned here about the prospects, where's your growth areas in Canada? Are you still going to concentrate kind of in the same ratios to where you're at, or do you see certain areas that you're pursuing as more opportunistic than what you have in the past?
Well, we've always been opportunistic, right? So that just goes back to my whole investment philosophy developed over 34 years. We are opportunistic. So, if we see opportunities in one area that we really like and that makes the most sense, and that's where we chase. And that's why I like having a few different pockets and buckets, types of things that we can do, because I wouldn't say I changed my mind, but I can see that at times there's pockets open up in certain areas of the country or, new. Like, for example, when we got into student housing, that was something that no one really was doing at scale, and it made sense for us. So that was an opportunistic play. When we started doing student housing for universities, that no one was really doing that. So that was, an opportunistic play. The same thing for, buying across the country. I think today, if, our strategy was always to go to suburban and ex-urban markets. The reason being that our core thesis was to buy or rent something in core Toronto, there's this concentration of institutional capital that wants to own that King and Blue location, and they're going to pay through a really high price to be there. So I think that there's this. I don't know, maybe it's your annual report bias, what shows on the glossies. That's one angle. The second is I thought, what the cores of our big cities, so MTV, Toronto, Montreal, and Vancouver, are very expensive. So we always thought the suburban markets were not only attractive because people can afford to live there, so it was an attractive thesis where people would, make sense for them financially to move there. Second thing is there was less institutional capital chasing those opportunities because of this, what I call the annual report effect. And, the cost to build in downtown locations versus suburban areas is dramatically different because you can use different technologies, right? So it sounds fancier than it is, but what I mean by that is if you build in King and Bay, just as an example, you need to build on a really tight little postage stamp piece of land, which means it's very expensive. You have to go very high, and you have to go really deep into the ground to build underground parking lots, and you have to use tightly maneuvered cranes, and you have to pay for crews to block. Well, you build something in Cambridge, and you do 4-story instead of concrete. You do, brick and wood, right? Much less expensive technology, much faster to build, which, as we talked about, recycling your capital faster. Now you can build maybe one underground of either podium parking or circus parking. So it's dramatically cheaper and faster to build, which means you can make the numbers work. And as a result, that means more of it's going to get done, which makes it more scalable as a business model to focus on those things. And I think also less risk because your rent per square foot is $2. So it appeals to what I would call the everyman or the every person. Whereas, to be a King and Bay and to pay $4 or $5, $6 a foot, there's a much smaller universe of people. So I think that's a riskier universe. And then to top of this all off, that was our philosophy pre-COVID. Then COVID comes along and renders our downtowns empty. And, people were locked in. And if you're up 42nd story of a condo building and you wanted to go downstairs to walk your dog, you had to wait 45 minutes to get an elevator down and back up because there were only 2 people per elevator. So and then everything you wanted to do in the city, which made it attractive to live there in the first place, your job you have to go to every day, and the coffee shops and the theaters and the restaurants and all those things were closed. So people explored this idea of moving to the suburbs, and not only did they get more space, it was less expensive. The buildings are newer on average. And since they're not having to commute for their jobs, and they maybe only commute 2 days instead of 5 days, and it's a little bit more time when they do, but the quality of life has gone up, and without the restrictions of downtown living. So I think it's really just turned people's recognition of the suburbs and exurbs completely on its head. And I don't think that that's ever really going to turn around. So it just kind of put what was our long-term strategy for almost 20 years and just put some rocket fuel in the engine. So that's a good thing.
Very true. Kind of a different kind of question, but I mean, we face this more because we're client facing. What would you say? I mean, for us, we take a business owner, we put some of their money in private equity. We take someone who lends money out to people, we put them in private debt. We have a lot of real estate investors, and I think that's a lot of work. So what would your comment be, or to somebody who owns a few doors maybe, and that's their way of growing their net worth? What would you say is the reason why they should look to Centurion or something of this versus driving past their homes at night and see if the lights are on?
So I've been asked that question many, many times by investors who say, well, I can own a condo. And I'm like, okay, you can own a condo and have zero diversification, and you're going to have to worry about fixing toilets and all these other things. Same thing with a singular apartment building. I mean, I started with one, but my plan was always to grow. You don't get the diversification, and you're still in the business of doing it. And unless you really like doing that, I guarantee you it's not really that fun. So I think what they get And I can say with, every bit of humility, I really believe that honestly, dollars to donuts, so to speak, we will do a better job of it. We just have so many people who are focused on it because we've got an organization of scale, right? So we're going to always get the best financing rates. We're always going to get the best in terms of, advice, and we put our buildings out to make sure we're not overpaying too much property tax. We're not overpaying on utilities. We've got people whose job it is to watch the utilities. We have systems in place to manage that. We have people whose job it is to rent the buildings, and it's not at the superintendent level. So all of our rental calls go through our call center with people who are professionally trained, and they're going to do systemic follow-up. So to the extent you can have 50 people who want to rent your unit, think you're going to rent for more than you thought? Yes, you will. Then we have, pricing managers whose job it is to, look at supply and demand, particularly in new lease ups, to say, oh, we just rented in a weekend every bachelor, or 75% of the bachelors. Okay, so we need to do something different. We need to increase the price of those. We need to take this view premium up, that view premium down. There's a whole section of people who just do these different specialties. No, I guarantee you, no singular owner would have the ability to do that. It was, even if they had the knowledge of how to do it, they wouldn't have the systems and the time to do those kind of things. So you have to be able to extract those efficiencies out of your portfolio really to drive long-term results, right? And it's not just about collecting the rents. That's important, but you also want to be able to manage your expenses and grow your revenues over time.
Yeah, and thanks for that. I mean, it's kind of the discussion that we have often enough, and even if you just went into the bare bones of not saying that you can run a business better than they can and make more money at it, you could just go to the, take your rate of return and basically give up the management fee to not have to do it yourself and get the net return from something like this versus having to worry about that. But there are people, they need to physically see stuff. They don't like getting a statement. They be able to reach out and touch something. I find
they have like 160 buildings they can go by and visit them and say they own a piece of that, but that might not feel.
Yeah, well, I think we do mention that with some of the Edmonton locations here too. But I think it's a lot of work, like you said, and those individual people. I mean, we all know it's harder to find people to help you now, as well. So some of these tradespeople that they relied on, are not always there. They go to different jobs, better jobs, government jobs, whatever picks them off. And they're there for your job, for your 3 doors that you have. You're doing it all yourself. It's really hard.
All for yourself. Look, I will tell you, I don't think what we do is magic, right? I am not the next AI startup, right? That's doing something highly complicated. And I really don't. I think what we do in principle is fairly straightforward. What we have is scale and specialization, which we've been able to develop with scale, and decades of experience, and the ability to experiment, right? So when we have new water saving technologies, we can trial it on a building and say, oh, did it work? And we have the team that's specialized that will know, oh, here's the results, and they know how to measure, and it worked, and they calculated ROI. It's like, okay, this worked. Let's scale it out, right? So all of those things are, I would say, is it possible someone who had 3 doors or 20 doors can do? Yes. Chances of you actually doing it because you know about it is low. And being able to execute on it and continue to monitor it is low. So I think it would be very hard. I think you put our returns against anyone who's doing this themselves, and we will beat them over time just because of those advantages.
Yeah, I would agree.
Right on.
Awesome.
Well, we touched on a bunch of stuff, Greg. It sounds like, rosy picture ahead for Centurion for at least the next decade. So we're along for the ride.
Well, thank you.
So thanks very much for sharing your time with us today.
My pleasure.
Our viewers, if you want to learn more, you can find us at smokinbulls.com and follow us on our social media. Of course, click to subscribe and like our videos, and we'll see you all again soon. Thanks again, Greg.
My pleasure. Thank you. Bye-bye.